While the investment landscape has changed somewhat spectacularly, the ability to forecast returns in the face of sometimes dire macroeconomic news is a key change. For starters, the massive rally in global developed market bonds, with all the bad news about deficits, credit ratings and Eurozone crises, caught everybody off guard. Herman van Velze from Stanlib joins us in studio for more. So it's really opportune for people to have been in balanced funds over this period, because you would have managed to navigate your way through the choppy water, wouldn't you?
Yeah, I think balanced funds have been actually the haven of prosperity, and I don't think balanced fund managers could have called the market as it sort of turned out. If you look back, say, last year or two, and you knew with perfect foresight what would have happened by now, you'd have been total out of those decisions and what you were going to do. So we're actually quite pleased that sometimes you don't know everything and that you have to make it up as we go. And we notice bond markets in the developed world did well last few years, followed by our own market in bonds, and in the equities at a new high. So how do you navigate between any of those asset classes? And who's calling them as the next big thing in the market? So balanced funds are the right place to be.
I mean, Herman, you've rightly stated, balanced funds have been the place to be. They've been the beneficiaries, because we've seen local equity markets really running up considerably. We've seen bond markets running up as well, and there's this whole kind of theory around all of this new money chasing all asset prices up. And the benefit, obviously, there of a balanced fund is that you get to benefit regardless of what your asset allocation actually is. I mean, that's really what the perfect storm has meant for balanced funds in South Africa specifically.
Yeah, because you don't know exactly what asset class to be in at what time, and neither does the balanced fund manager know for most of the time, I would guess. But he also gives you the diversification. So when you get some asset classes maybe less right, but others will then take over when you expect it the least. And that's been a story that we've seen for some time.
I mean, the burning question for me, really, Herman, is that, where to from here? We've almost, like I said, we've had the perfect storm.
You took the words right out of my mouth.
We've had the perfect storm.
We've
got asset equity prices making record highs locally. We've got bond yields continuing to trend lower. Where to from here?
Well, balanced funds have the advantage of being able to switch between asset classes, either by selling them out in entirety. Our portfolio has no global bonds left. We sold them out in end of 2010, early 2011, which wasn't maybe the best time to do so, but we already had 4 or 5 years of rallies. Post that, our portfolio went into commodities. So the balanced fund managers, with some conviction, are able to navigate between asset classes. So when an asset class becomes particularly oversold or overbought, we were able to either buy or sell them. So there is some room for actually adjusting that portfolio, because you have about 8, 9 asset classes to choose from, and we run about 6, 7 at any given time. So at the moment, there is a bit of room. So we would probably say balanced fund managers, that would be the best sort of place to be, because that's where they are able to navigate you through that.
So let's talk about the asset classes now, and South African bonds trading at an all-time low. Where to from here, if we can break it up piecemeal?
All right, piecemeal. SA bonds, we still see some comfort there. The search for yield globally is unabated. I mean, there's no other way to go with cash yielding a negative return. Global bonds are unattractive after cost. Emerging markets bonds remain attractive. So from our point of view, they yield better than our own money market funds. So for our perception is we'll rather still use that search for yield as our theme.
How do we compare with other emerging market bonds?
From South Africa's point of view, we'd rather own our own bonds than diversify into other jurisdictions, because the vagaries of currencies at those jurisdictions will actually could be detrimental to our portfolio. So from our point of view, with your client looking for a rand return, because at the end of the day he still needs real general money to go forward, we prefer to take emerging bonds solely in South Africa. We no need to diversify from them.
Something I'd like to maybe unpack a little bit more with you as well. So I would agree with the whole relative bonds versus equity argument, for example. But then let's have a look at commodities, because again, if we look at our equity market, we're intrinsically linked to a commodity cycle, albeit yes, the industrials have recently risen, and that's a larger part of the top 40 right now. Your view on commodities in aggregate, and maybe break that down for us in terms of precious versus base versus softs.
Our view on commodities remains a bit lackluster. We don't have a big opinion that commodities will be the next big thing, and that's the place to be. Our opinion is that we'll probably see commodity prices trending lower rather than trending higher. And when that happens, it sort of takes away the investor confidence. So from our portfolio, we'll stick to some of the quality names in commodities like BHP Billiton, and on the precious, probably Impala Platinum, just to have a foothold. Because one day we may see something changing and we won't be able to react fast enough. But in general, it's not time to be in commodities.
It's not time to be in commodities. Do you think that the story is going to be somewhat beleaguered in that space for some time to come then? It sounds as though that's where you're going.
The cycles have seemed to be elongated, so they're taking longer to actually manifest. So once you've had a strong market, the weaker markets may take a while to maybe 2-3 years. So our opinion is that we shouldn't see a major rally in commodities.
That's in line with your thinking, isn't it?
Very much so. I mean, we've been pretty vocal about that view. We're concerned about China, specifically the slowdown there. And we tend to be very early on a lot of these, particularly for that reason. We're saying the cycles are taking a little bit longer to play out. But when we look again, let's look at that equity market, because that's been the wild card. The South African equity market, in dollar terms, is doing what your other emerging markets are doing. But in rand terms, continues to make new highs. Now, within there, maybe unpack that for us. What do you have appetite?
If you're not extremely excited about the resource story, well, what are you excited about?
We've been bullish on industrials for some time. That's been
which has worked,
our story, and we haven't deviated.
And you're sticking to it.
You can't be a bull in industrials if you don't own retail. And if you don't own retail, then industrials may pass you by. And results in retail sector staggers people. I mean,
Shoprite came out yesterday.
Another 20, and our analysts are guiding 20 going forward, and they say maybe they'll temper it to 18. That sort of seems to us still a good place to be. Healthcare is a phenomenal sector in South Africa. It is the leader in terms of the ability to be able to price and grow that volume. So from our point of view, healthcare, retail is a good start. And then you can actually temper that with the telcos, which are yielding above 5 or more if you're in Vodacom, looking at the Vodacom numbers. And then you can sort of get that sort of comfort that you can have some of the growth shares which you shouldn't sell now or hardly ever, and then you can rather own a few others to sort of to ease the sort of specific risk you may have by owning too many retailers.
So I mean, on the retailers, whilst we're still on that point, I mean, PE's north of 20 has had many people concerned for very long. It doesn't stop the share price from continuing to run through the cycle. What do you see breaking that? When do you see that turning if you're still very bullish on that sector?
We look carefully for margins and volumes. So volume growth, either revenue or units sold, but and we look carefully if that's still intact. Once margins and sort of volume remains intact in the sort of key retailers that we sort of follow, you probably can extend that curve, that PE curve, quite far. So our opinion is that don't get too gung-ho on the PE, because that is only a symptom of the earnings. And the driver of earnings is volume and margin. So when they retain their position, we would probably say it could be a few years still.
But at a 20 PE, Bronwyn, at a 20 PE plus, I mean, that implies an earnings yield of 5% and below.
You speak like someone who is not in the retailers.
No, I'm very curious. I mean,
moment you're buying the business, you're not buying the rating. If you buy businesses and you buy a good business, there's often a lot more room to own the business. I don't see some of the CEOs in those retailers selling their own shares. It's one of the underrated sales from insiders is retail. And
and this is the discussion. We had a huge discussion with Sid Vianillo from Nedbank Capital last night on this exact space, in that at your own peril, get out of retailers. Yes, you've made a lot of money if you've been in for the run, but at your peril, get out now.
Yeah, we disagree. Well, we agree with Sid.
You agree with Sid,
so
absolutely.
Selling is not and you don't have to own a third of your portfolio retailers. You need 4 or 5, and you're well catered for. So it's not even a difficult decision to get into a couple of retailers, because they're still out there.
We've got to bring property into the discussion. This will obviously complete the picture. Where do we stand with listed property? And again, it always comes back to the sustainability of performance with these. When to drop it as an asset class or to reduce your exposure.
We, as I mentioned earlier, you take conviction asset classes. We sold property probably about towards the end of last year, which was probably a bit early for the last rally. But for us to replicate property, we prefer industrial shares. Because at the end of the day, the industrial shares grow their earnings a lot faster than what the property income growth is. They're currently yielding in the same region as a property stock. And we find it a little bit overzealous to re-rate their property shares at the pace that they have been rated. So from our point of view, we'll rather stick to a healthy dose of industrials, and that would sort of cover us in terms of risk. So whilst property shares perform, industrials perform at sort of similar pace or not too far behind. And for the last 3 years, industrial shares have way outperformed properties. It's just the last few months that they've property come back to life. But today, from our point of view, would rather be into the higher growth industrial shares than in property. So that gives you another clear picture that sometimes you've got to sell the asset class.
Is there one risk on the retail space in terms of foreigners, and obviously the high exposure that foreigners have got to our retail stocks? If risk aversion became the order of the day in a big way again, because that foreign money is traditionally fickle, and this is the question I put to Sid last night, isn't that the glaring risk that you face?
We looked at the last couple of years, and the foreign ownership in those shares have remained reasonably static or growing. And whilst quality is hard to find in the world, and investors seem to sort of flock towards it, and maybe, Mohammed, your point on the rating, you may get nervous. It could give you some sort of discomfort on rating. So we feel the foreigners have been reasonably resilient in their positions. So at this stage, we think they are less prone to sell than some of the locals, I would think. So we sort of at this point see that as a sort of the comfort zone that they own it, and we're not expecting them to be big sellers because they haven't done so for quite some time. When quality diminishes, they're out of there. So you look at the quality of the business, and that would be the key.